How many deals that you get, you have us vet and look at. How many deals I get, you look at. That quote of it takes a village of people in your corner when you're looking at these deals to say that you're going to give somebody between 20 to 40% in the next 5 months. I don't know what kind of pitch deck they had on paper or whatever, but we know looking at that, that's a red flag in itself, right?
You got somebody else's money. The number one rule in investing is what? Don't lose money. The number two rule in investing is don't lose money.
Welcome to the All Blends Perfectly podcast. Keith, Ryan, Harrison, Coalition Properties, and friends talking about the intersection between lifestyle, real estate, culture, art, and everything in between because it all blends perfectly. Good day, good people, and welcome to another episode of the All Blends Perfectly podcast. We back together, man. Boys are back in town.
We back, baby. We back
in time.
Yeah.
We out here.
Tap me up one time. Miss y'all boys, man.
With my brothers, we back in the saddle. Mr. Ryan Butler.
How you doing? I'm back.
Mr. Keith James, a.k.a. Jimmy Kenneth.
Boys are back in town.
Don't hit him. Don't hurt him. Don't hurt him.
Ooh, kill him.
And we coming up on the end of the year, right? We had a very fast, brisk, I don't even know how to describe time, how quickly it has passed.
Snap the finger.
Right?
I know you like that sci-fi stuff, man. Just like,
Thanos.
Boom.
It goes quick. It goes quick, man. But it's important for us to get some more good content recorded and have another conversation. We want to bring both some timely, news-relevant material to you and give you some of our feedback and perspective on it. So, Keith, would you mind telling us kind of what's big in the news right now and why you wanted to have this conversation today? Yes, please.
I would love to. Mm-hmm. As we all know, and it's funny, I've been getting a lot of text messages and phone calls about this, and it's real estate related, right? I'm going to read this news article. DJ Envy, that's how you say it, right? DJ Envy. Mm-hmm. every link to businessman charged with multi-million-dollar Ponzi-like house flipping scheme. The radio host has come under scrutiny for his connection to Caesar Pena, whom he's frequently featured on The Breakfast Club, right? And as we all know, The Breakfast Club is a very well-known podcast, recording,
radio show,
platform.
It's like cultural icon. I feel
really
like a lot of
cultural
important
icon.
things come
Super.
out of The Breakfast Club.
Probably the number one most cultural, iconic show
for sure
for radio talk in the morning. We can all agree,
I agree
right?
with that. I agree with that.
And so Caesar, who is very good friends with DJ Envy, has been featured on here. And that's actually how he got his following up, to be able to promote this business and basically raise money. People investing in money, seminars and things of that nature. And I wanted to raise the question of, how do you guys feel about this? Is this something that DJ Envy is aware of? Do you think DJ Envy knows he was, stealing money and things of that nature? So I want to raise the question, how do we feel about this?
Well, if I may first, Keith, you threw out the phrase Ponzi scheme, and I feel like that word gets thrown around a lot. And, I like to use big words, but I'm going to look this one up and define it. So a Ponzi scheme is one where instead of investing generated funds into viable businesses, the initiators of the scheme use the funds from later participants to pay off earlier participants, and in the process, they divert large amounts of money into their own accounts and pockets. The Ponzi schemes were named after Charles Ponzi in 1919. The more you know.
Yeah.
So to answer your question, Keith, I feel like it's an unfortunate marriage of a trusted name in media, which is what DJ Envy and some of the other folks were, with a sexy concept that I can be a real estate investor, right? And for a nominal or even a modest amount of money invested, I will get crazy returns. And I think that's one of the important things I want folks to realize whenever an idea or a business or something is brought to you, and the returns and the results seem a little bit too good to be true, or a little too great, too fat, too whatever, your eyebrows should raise. And I feel like in this case, maybe folks' eyebrows didn't raise. They were trusting it. They were hoping for the good outcome at the end.
Absolutely.
And it's unfortunate. It's not new by any sense. There's been lots of these over the years, but this one, I think, specifically for the connection to hip hop culture, popular culture, media, is getting more buzz and press, but it ain't new. You know what I'm saying?
Yeah.
It's been out here.
Yeah.
And Ryan, I kind of wanted to ask you, because you have helped people on the legitimate side, raise money for real estate deals. When you hear about these kind of Ponzi pyramid, other schemes around real estate, what do you want people to kind of know or think about to maybe avoid them a little bit?
Well, even before you get that, I'd like to know how are they defining this?
Yeah.
Meaning,
Yeah.
because you can screw up things on purpose, and you can screw up things on accident.
Yeah.
It's funny because we also think of like Jay Morrison, think of some other people who I don't know if they were actually on purpose per se. They just might have been too big for their britches,
Right.
and they were trying to do something and didn't know how it worked, and then you lose money.
Yeah.
Just like on a lot of things. So my first question is, how legitimate is the Ponzi scheme? Because I also know that is that what the federal like?
Yeah, that's according to the filing. I'll give you some details.
Yeah.
The investments, one of the main things they said is they would offer between 20 to 45% return on their investment within 5 months for putting money into this fund to buy, renovate, remodel, resell real estate properties.
Right.
Like that's what it was. So it was saying,
Right,
I'm going to get you your money in and out 20 to 45% in 5 months.
Yep. And then what happened when they got the money, though, is what I was really trying to figure out.
They kept pushing the timeline back on it. Yeah.
Yeah.
So I mean, I heard about it. Everybody's heard about it, but I didn't know the nitty-gritty details of what's going on. Quite frankly, trying to return 20 to 50% returns in 5 months.
That's high.
Woo! Sign me up.
Yeah, right.
Yeah.
Right. That's high, man.
Sign me up.
Yeah.
I mean, that's ridiculously high.
It is ridiculously high.
If you look at the highest levels of investors who actually use other people's money, so they have some degree of, thought and process around protection is high, not just like you flipping your own money and you take higher risk, etc. But like if you got somebody else's money, the number one rule in investing is what? Don't lose money.
Yeah.
The number two rule in investing is don't lose money.
Facts.
So
Facts.
don't lose people's money. And look, that happens. It does happen. You can't say like everybody's gonna lose some money at some point.
We've lost money.
We've lost money.
Yeah.
If
On
you play the
legitimate
game,
deals.
on legitimate deals. If you play the game long enough, you're bound to lose. You're bound to have some that might lose some money. However, it's like Beach always says, his spidey senses goes way farther than faster than everybody else's for sure.
Yeah.
And it has protected him a lot along the way.
Yeah.
But yeah, man, that's a lot of
a
lot of expected return with no real infrastructure, I'm sure, behind it.
Yeah.
I think
Especially with flipping. Flipping is like the biggest
right now
risk. Well, I mean, across the board, generally, like flipping is going to be like the biggest risk.
Yeah.
You know what I mean?
Yeah.
And why is flipping like a big risk for folks that may not understand?
So flipping is essentially buying something, maybe buying a property, maybe adding value. I mean, quite frankly, you can flip anything, right?
Right.
It's
Yeah.
what they say: get it for the low, sell it for the high.
Yeah.
That's what it is. It's getting it for the low and sell it for the high.
Yeah.
Now, in the real estate world, getting it for the low and sell it for high, you can do that too through time.
Yeah.
Right? Over time, natural appreciation. You can also do it through forced appreciation. That's when you add value to the home. So if I take a beat up home, a grandma home, a home with fire damage, all these different things, homes that can't get financing from the bank, and then I get it at a price where it's risk adjusted for me, then I go and fix it up. And then I sell it. I should expect to sell it for more, much more money than I put in.
Yeah.
But I got to be careful to make sure it's more money than the renovation costs that I also spent.
Right.
So that's flipping. And usually in a house flip, you can see that done in as short as, a couple weeks.
Yeah.
On development, it could take a couple years.
Yeah.
But fundamentally, it's all the same. Buy for the low,
Sell it for the high.
sell it for the high.
Right.
That's a flip. But and they try to do it in a short period of time. Flip. Move the money fast.
Yeah.
And that's how you really get in trouble, where investing is not actually flipping.
Facts.
That's not the same thing
At all.
Yeah.
Investing means that you are buying something that you expect appreciation, cash flow, growth over a period of time.
Yeah.
Right?
Yeah.
Whereas flipping, if you really, you can go rich dad, poor dad, 4 quadrants. You have employee, you have self-employed, you have business, and you have investor. So the flipping would go under business because it's an operating business.
Right.
Absolutely.
And not an investment. Now, the people who put the money in, they're the investors.
They're the
That's
investors.
that's the eye for them. They're the eye quadrant.
Yeah.
And in theory, that's what the folks in this, transaction scheme were supposed to be doing. But the shorter projected return and such a high significant return would mean they're turning 80, 90% profit to be able to give out 45%. Like, and the math just don't matter.
I think too, the overall fundamental issue with this is the platform that they were using, right? To promote
the amount of trust on that platform.
You know, this guy was supposed to take them to the promised land. Yeah. You know what I mean? Yeah. And a lot of times when you have these platforms and you've been a trusted platform, you know, for so long, where people like us are tuning into and believing and listening, and trusted listeners that even came to these seminars and put money into these investments and lost money over time. So it's on the predatory side when you think about it.
Yeah. And there's a whole government entity that was created after the market crashes of 07 and 08, the Consumer Financial Protection Bureau, to create structures that make people at least ask questions or create some barriers to protect consumers from being harmed like this. And I do want to make a couple clarifying notes about DJ Envy's involvement here. He was an investor himself. According to documents, he put up $500,000 of his own money into the deal. Has not made any of it back. Right. So he is taking that L. But the bigger problem that we talked about is leveraging both name and platform and participating in bigger seminars to bring other people. Because I remember seeing advertising for these, right?
He was on there all the time.
I don't know if it came here.
It was a Facebook sponsored ad for so long. I seen it all over Facebook, Instagram.
Well, you always see DJ Envy talking about it.
Always.
Always see DJ Envy talking about it.
And I assume there was some type of, because this happens too, I feel like it's a whole other conversation about what do you give up in exchange for brand promotion or brand connection, right? Like, am I, as the name that's being leveraged, are you giving me a slightly better cut of the deal on the other side?
Sure.
Like, what am I leveraging and negotiating? He didn't do it out the kindness of his heart, but his intention was to bring a true wealth building vehicle to his community. So like the intention was there, and that was good. And he also lost his money. I just think there's two bigger conversations around looking at the fine print behind somebody endorsing something, and if I trust you, what's the thing you're also asking me to trust? Am I looking close? And two, if I am someone that has a platform and has a name and people do trust and listen to me, how well am I vetting the people I'm getting into business with and the product I'm promoting?
Who you partner with matters.
Yeah, for sure. Well, here's the other thing, right? From DJ Envy's side, it's, look who you're investing with. Number one rule of money is don't lose your money. Yeah. But as an investor, someone who's giving out money, the number one concept is you could lose all of this.
Right.
Be clear.
And that's what I feel like that's what's missing a little bit, because some of the people that have been able to invest in some of these things, I mean, they were given like, all I got is 5.
Yeah.
So, man, make my money back, man.
Right.
Hey, man, make that 10 for me.
Yeah.
Make that like whatever over a year. If I give you 5, give me 25 back. That's easy money, man. That's I got 7,500. Right. So I feel like a lot of people who are investing, you could lose it all, man, when you're investing. Like, it's not guaranteed because nothing is safe. Even the U.S. government. I mean, it's fairly darn safe. Bro. But man,
and it takes a village.
Empires.
It takes a village too. How many deals that you get, you have us vet and look at. How many deals I get. You look at that quote of it takes a village of people in your corner when you're looking at these deals to say that you're going to give somebody between 20 to 40% in the next 5 months. That's kind of that doesn't it. I don't know what kind of pitch deck they had on paper or whatever, but we know looking at that's a red flag in itself, right?
Yeah.
So for the people out there that are listening, when you're getting deals, when you're getting approached, but I don't care if it's crypto, real estate, whatever it may be. We'll talk about crypto later. Yeah. Where the crypto
people at? Where the crypto bros?
Sam Bankman-Fried.
Real quiet.
Yeah, they're quiet right now.
But for his defense,
make sure you have people in your corner that are helping you vet these deals and that are helping you, a professional that does this on a daily basis, because you don't want to be in a position where, like these people, they got robbed of the opportunity, thinking that they were going to be successful in the next 5 months with a return on investment, but actually didn't get anything.
And also, I think part of it is just that there are people who are suckers for that type of return, because if you try to tell someone about more of what I call like a more standard return,
10%, they're not gonna. Yeah,
they're like, I flip that, dip that. I
can flip that in 2 weeks.
Yeah, I can get that back in 2 weeks. And what they don't realize is they had to go and work for that.
Yeah.
That's the part they always forget.
Facts.
It's like when you're actually investing, when you're truly investing, the key is you're putting in money and letting that money work for you with minimal time.
Yeah.
If you have both a time and money commitment, that makes it more that makes it an operating business at that point. You are operating in the business, which is totally fine. But if we go back to that quadrant of E, S, B, and I, you're working more as a business when you're spending time. When you're spending time and money, that's business. When you're spending less time and more money, that's investing.
Right. And, like we always tell our clients, we're not in the business of hitting home runs. We just want to hit, this is a baseball term, we just want to hit singles and get on base every single time, right? We don't want to hit home runs. You just want to continue to hit singles, get on base, and making sure you're making sound investments, because at the end of the day, you can go to the Hall of Fame getting on base every single time. And over time, short-term sacrifice for long-term success, you'll have a better portfolio looking at deals like that than you would of trying to hit a home run every time you get at bat.
And I feel like the other piece too, there's a trust that can be built in.
Yeah.
If my man put me on, right? Got a great concept, got a great idea.
Caesar, his best friend.
Caesar's best friend, yeah. Right? Best friend. But apparently there was like some other, like somebody else that endorsed it too. Somebody else that endorsed it, right? How do we either respectfully or consistently vet friends? Yeah. Because I think that's another problem and story here is like trust that was built in that maybe caused some folks, a lot of folks, I don't want to project the intention of the folks that were involved in it, but maybe they didn't look as close at the details. Maybe there was a side where they had no idea and they had nobody else giving them eyes, but there was probably folks that knew but said, you know what, you my man, my money's with you, like look you in my eyes and I trust you. Yeah. Like how can people, is there a thought path people can go through to like help protect themselves or ask questions in those situations?
I think we skipped one important piece though. Mm-hmm. I wonder if he had success. Because if he had success,
he had proof of success that people saw.
Then he was doing it. Because sometimes, again, I really go back to all of a sudden all this money's coming in, and now he got to deploy all of this money. Mm-hmm. Whereas before, you had $100,000, $500,000, you can wait and find a good deal and not worried about it so much. And he had the skill set to take on 3 deals at a time, or a couple deals at a time. And then all of a sudden, you got all this money. Now you got to take on 10, 20, 30 deals at a time.
Yeah, for the math,
like it's a different the problem. I'm not saying he's not a fraud because I don't know him like that. Mm-hmm. And I just don't know as deeply in this situation because quite frankly I haven't been following it as much.
Yeah.
I see the headlines obviously and you read like a little snippets here and there, but I just wonder if at some point he had a legitimate business and then it got away from him.
Yeah.
Yeah.
I mean, hence him having to go on the Breakfast Club to promote it.
Yeah, once someone said, "Man, oh man, this is my guy. He's flipping homes. He's making $3 million a year." Say, well, what happens if you raise $30 million? Right. It's like, great, I can do that.
Yeah,
Some people think,
but you actually can't.
But look, man, because that's that entrepreneurial spirit, and I think it comes from the energy of folks making it from nothing. Right? Yeah. They say like, hey, if I came from nothing to where I am now, where can I go from where I am now?
That's
to
an interesting point. That's an interesting
Yeah.
point, though. That makes sense. That's the other side that you don't really see in the headlines.
I'm not protecting DJ Envy and Caesar. I just want y'all to know that. I don't know this. I don't know the man.
Well, and to be clear, it does appear Envy was just a kind of promotional partner and name in marketing, that he was not involved. That's his defense publicly, that he was not involved in the back end of it. For sure. He was just on that side. But but when your name is right next to somebody and they doing the crime, be like, I mean, I was in the room. He was doing the crime. I was in the room next door.
Guilty by association, like my granddaddy said.
It's a real thing.
Yeah.
Unfortunately,
he was just a bigger fool that brought more foods to the table.
Do you think he should get fired from iHeartRadio?
Man, I thought about that because I was like, you brought him on and you were invested in that. Mm-hmm. Like that's a heavy conflict of interest on that piece.
But the conflict of interest piece in legitimate businesses, I don't think it's all about disclosure, right? And the ethics of it. Like this is why organized real estate has so many rules around ethics and dual agency and who owns something and ownership interest. That's the challenge when you get with some outside just real estate investments that are not structured. There's no rules about who tells you who owns what and why they're endorsing it and how hyped they are. So to answer your question, I feel like from a brand perspective and how much negative press this is getting, iHeartRadio is probably going to have to make a move. I don't think they can continue unless, as a result of the trial, it turns out that he was completely swindled and there was no communication that he knew anything of the scam. In that case, it's probably poor judgment, and I don't know if he should lose his livelihood for poor judgment, but it will probably change his prominence, and we know it's going to impact other advertisers. Because right now, like, where's the real money in radio? It's in advertising.
Well, you
right?
say like he maybe you're like, oh, he shouldn't lose his livelihood, and I agree from his perspective. I wouldn't want to lose my livelihood over that. But like you said, if the money talks,
right?
So the advertisers are looking at them like, yo, like revenue's gone down. People don't trust you. There's number negative, like
your brand,
things.
The value to
the
your
brand value went down. Like, yo, you gotta go, or we cutting back.
Right.
That's a real possibility.
So they take the choice even out of iHeartRadio or the corporate partners' hands.
Look
the
at the numbers
coming in. They're like,
exactly. That's what I'm talking about. It's like the money ain't coming in. They're like, man, I don't care if you lost some people money, but you losing me money.
You losing me money, right?
Oh,
it's a different story. Yeah.
Whole concept. What did it say? CSR, corporate social responsibility.
Corporate social responsibility.
It's a good idea when it adds to the bottom line,
right?
Like, let's just be real. Like, they're like, oh, all these black and brown investors that were harmed out here, we at iHeartRadio would never, blah, blah, blah. The real reason we getting rid of your black ads.
Right.
Because our advertising dollars ain't coming in.
Wait, I'm sorry. I don't mean that. Is DJ Envy black?
I mean,
you're looking at a racially ambiguous man right here. I'm going to give him the benefit of the doubt. I'm going to pull him over. I haven't seen him without a hat, though. I have not seen him without a hat.
He totally might be. He did go. Did he go to Howard? He went to HBCU, but that doesn't mean.
Consult the internet.
Yeah, consult. Now everybody look it up.
Yeah,
it's a great. Also, his friend, the homie he's talking about is Caesar too. So I'm like, it's like another Latino brother.
It gives me something within the diaspora. I feel like either the diaspora was there. I don't think he's like a Sean King situation, right, where everybody like thinks one thing, but he's just the complete different.
Yeah. Well,
he identifies as African Americans.
Okay. It's funny because I never thought of. I thought about that question a lot.
That's a real thing.
I never asked it out loud till just now.
Yeah.
It's a great question.
It's a great question. I'm sure. I wondered, did Charlamagne the God ever say anything to him like, "Hey, DJ Envy"?
Because there's no question about Charlamagne.
Is he a real DJ?
Yeah, he was a real DJ.
Yeah,
he was the man for a while, bro.
Yeah,
it was the man.
Yeah,
I just
the connection to hip hop culture.
He was like, is he black? That's why I asked.
That's the same.
Is he real
That's
at
the
all?
second question. Nah, is he a real? Is DJ Envy a real DJ?
Yo,
the second question.
Oh,
yeah, no lie.
Oh my God. Hey, that was
because a lot of people that use that title that at one point you were and now you're not. Like DJ Cool, Let Me Clear My Throat.
Yeah, like
he is actually a DJ. What you say?
Hey yo! Oh my God!
See
back,
him, see him,
back,
bro. See him,
back.
Two
Boy's
things
back
at the same time.
At the same time.
Talking about a song, man. Talking about a song, man. Just in search of the eternal pause. That's what I'm gonna put in a shirt. I'm gonna give you a T-shirt. Just need a sign where you slowly pull it up.
Like, what you do?
Pause.
You can just do the one that flips over.
Pause.
Flips over.
Oh goodness.
Man.
Oh man. All right. Well, I did have a couple other questions about scams and how we think about them.
Yeah.
When I asked,
you clearly gonna have to chop this one up.
Hey, it's a flow. It's conversation.
For sure. He said, "Let me clear my."
Yeah, it's a song.
All the DJs in the world.
All the there's so many DJs you could have pulled out there.
All the DJs you could pull.
Is that the same person with the cha-cha slide, Beatrice?
No.
Oh, okay.
That's DJ Casper.
Said that one then.
That's DJ Casper.
Yeah, you could have got what's my man Fresh Prince and
Jazzy Jeff.
Oh,
that's one of your favorites.
He's not questionable though.
He's not questionable. He's
the context he was.
I know, but I'm saying like you could have used another
show a positive one who like there's no question that he is. Yeah. Okay.
Let me clear my throat. What
was your question, bro?
Yeah, you got a question, bro?
I did.
You still have it?
Yeah, because earlier, like, how do people protect themselves? Like, we talked about red flags, like speed, like if it's the returns are too good, if it's happening too fast, if it's endorsed by a big person that's super excited. How do people protect themselves against something that may be a scam?
Liens, that's the first thing.
Mm-hmm.
So the ownership of the property, like if I give you money, right, and then I, in exchange for that, there's a lien on the property.
What is a lien?
So a lien, when you buy a home and the bank gives you a loan, they put a lien on the title and the deed. That way, if something goes wrong, they get paid out first. So it'd be the first lien. It's usually the bank. The second lien would be the investors. You can't do liens in a fund though. That's a tricky piece. Yeah,
I don't know if people know that.
I don't believe you can do a lien in the fund because the fund is a general pot.
Yeah, it is.
And so you can't just be like, oh, this fund has a lien on all of these things. That might not be true, but from what I can think about, I'm thinking about it. Can a fund put a lien on a property? So that's a good question there. And then the other thing is since 20. We talk a lot about, or not talk a lot, but in America, a big topic of conversation is always about government regulation.
Yeah.
And there are people, both sides of it. Some people say, let the fools lose their money because, it's a free market.
Right.
And so if it was supposed to win, it would have won.
Yeah. It would have hit.
It would have hit, and it didn't. So, but in 2016, when President Trump was in office, he had a lot of kind of laws, regulations around real estate. I mean, he's a real estate guy.
Yeah.
Oh yeah.
And so, I mean, that's where some of the tax savings things on real estate came in. Yeah. But that's also when you were allowed to do the crowdfunding for real estate. Mm-hmm. I'm pretty sure
more mechanisms to raise money to buy real estate.
I'm pretty sure that was in 2016. It might have been a little bit before that, but I mean, we even have a classmate who has one of the top basically crowd-funded platforms for commercial real estate. So shout out to Jilly Hellman. And that platform allows you to basically bring in funds to get a real estate deal done. And so a lot of people were looking for creative ways to do certain types of deals because the returns were more profitable and advantageous. And so what that does, though, is on the good side, it was great. But when the government started putting the screws in, and everything started going up on interest rates and returns, I mean, it affected everything top to bottom, right? You couldn't sell as much as you thought you were going to sell. Yeah. You couldn't buy for cheap as you thought you was going to buy it for. Yeah. Maybe you were going to buy it for a certain price, but now the interest rate high, so the translation and payment changes.
The math is different.
The math is just totally changes because interest rates drive a lot of real estate investments, quite frankly. So
when I think of, in terms of what people can be aware of and just how you compare something that is new and exciting to something that is vetted and established and real, if you ever hear any brokerage commercial, like we watch in sports, there's a tagline at the end of everything. Like first one that comes to mind is Franklin Templeton Investments, right? What's the tagline that they always say? Investment in securities involves the risk of loss. Like they say that verbally at the end of all of them. And that is
past performance is not indicative of future returns.
Right. Yep. And those are if that is the rules, and those are the two things that are always associated with structured, regulated investing. And there is something else that promises you both better returns, quicker returns, higher returns, and nobody is saying that, explicitly looking at you and saying that. That to me is a red flag, right? And even if they're saying it, but it's in the fine print or whatever, I feel like that's something people should be more aware of, that if I'm a legitimate investor, you need to be aware of, especially if you're not a qualified, because there's different criteria for people that can invest in real estate.
Yep.
Accredited
investor versus a sophisticated investor.
Right. And I don't know all of the criteria of the folks that were in there, but I assume they've got a bucket of folks that were in that either unaccredited, unsophisticated, not as specific, right?
I'm sure they were raising in the 3,000, 5,000 range, et cetera. Yeah. Because we can do that with the crowdfunding. Yeah. Whereas sometimes that doesn't make sense on the syndications and because you can only have so many non-qualified, non-accredited investors. Excuse me. So there's a maximum amount you can have. So you gotta have less people with more money to get those deals done.
So what is a good, and question for you, Ryan and Keith, think about this from what you've seen. What is a good, if someone comes to me with a real estate investment opportunity, right, and in buying and flipping and making a fund to do things, right, what's a return that is on the realistic side, but good or bad? You know what I'm saying? What is a range of numbers? If it's not the 20 to 45 in 5 months, what's a range that, and again, this is not investing in securities involves a risk of loss. Past performance does not indicate future, but there's also just what thoughtful investors think of and know. How would you answer if someone's asking you that question, Ryan?
It's funny. It's biased. It's why, I don't like investments on flips anyway. I would ask, yourself, what type of investor are you?
Yeah.
20 20 to 45% returns on flips is just a super red flag for me. You know,
and that's a big range too. That was
that's
my
a
one
huge
question
range,
too. Like
it sounds like he was robbing Peter to pay Paul.
Exactly what
and moving it on down the
was.
line, kicking the bucket. You know, they say kicking the bucket on down. You know, this is the fundamental thing where I go back to the basics. If you're putting your money anywhere in the world and you're getting 8 to 12% return, right? You're doing amazing.
Yeah.
You know, from a index
protecting
fund, you're protected. You know, that's just like the golden rule, right? Anything above that, you know, it's amazing. And in real estate investing, right? You know, investing, you know, if you're doing, you know, 20%, 25% from a buy and hold, cash on cash returns, those are great returns. But I like anything above 8 to 12%, man. And 10% to me is safe.
Yeah, for sure.
10% is safe.
I think one way to look at it is there are some rules of thumbs in real estate investing. So you'll see people talk about 1% rule. You hear people talk about the 70% rule. And so basically you look at a property, you look at the after repair value, you take 70% of that. So say a property appraises for $100,000. Obviously we're not in DC. You can do it at $1 million if you want. If all of your hard costs are in at $700,000, that rule of thumb, you've met the requirement. And so at $1 million, that's $300,000. At $100,000, that's $30,000, right? Well, so what if it's 80% instead of 70% or 85%? Because you're still looking, it's like that's still $150,
right?
That I made. You know, we're not accounting for soft
100%.
costs, etc. Yeah. But the reason you do it because you know, once that's just a hard cost, you're gonna add in some soft costs with how you pay the realtor. Yeah. If you got a loan on it, paying the lender, transaction fees, all those things can really add up to like another 10%. So now you're making 20% of the of what the property the after repair value is. You're making 20% of that for take home, and that's before taxes because
before
taxes.
Before taxes.
Right? Yeah. So that's before taxes. So with all of that risk that you just took, because that could take, you know, some people maybe taking 30 days, but in our market, I mean, you're talking like a 5-6 month thing if you're good.
Yeah.
It could take you a year if you're not so good. It could take you longer where you're trying to offload if you suck.
Facts.
Right? So, speaking of which, I got to reach out to some people. So maybe think about it. Oh, man.
Yeah.
So I only say that to give people a little bit of perspective on like what the flippers, if you will, are looking like. And so if it's 70% or better, if you can get it for 50%, then go for it. You made a lot of money, right? But with that rule of thumb and the money that is needed, it's tough to say how are you going to get your 20,
where's yours going to come from in that pie?
Yeah.
Like what's left?
I think on your point, Ryan, like what are some questions people should ask when they're being presented with these type of opportunities?
Yeah. I mean, the first one I'd say is if you are, you as the person organizing this, how much skin do you have in the game? That's something I'm going to ask too. Like, I know my money helps get us there, but help me understand your exposure, your investment. We in this together, right? Like, how much are we sharing the risk? Yeah. And a sophisticated investor, syndicator should know that and be able to say that with no problem, point out what they're getting.
Put some money in it.
And the second would just be who else, as an outside source, can show me that what you've done has worked before. Like, I don't want to be your guinea pig. I don't want to be the one you're test driving this on. I don't want to be the first one unless, again, if we got a close relationship and we in it together, I know a little bit more. But if I'm the first one that you're doing this with and it's a significant amount of money for me, that's just, you know, from my risk tolerance, as y'all know.
Yeah, for sure.
That's too much for me.
Facts.
Yeah.
Cool. Great episode, man.
Well, I think, we covered a lot today. It was really, relevant to what's happening in the world. And I think the biggest message is to make sure you are completely vetting where you put your money, have an understanding of kind of what it looks like.
Be ready to lose it.
Investing involves a risk of loss, right? But also just think about the sources that are presenting it and look a little bit closer with all of it, right? We all want our communities to win and invest and get in the game at a high level, but there's ways to do it and ways to not consider it. Following more of our content is best done on YouTube at the All Blends Perfectly YouTube page. On social media, we are at All Blends Perfectly. This gentleman is at Ryan Butler Hoya. He is at Keith James Realtor. I am at HL Beach, and our sales team is at Coalition Properties. Thank you so much for joining into the All Blends Perfectly podcast. We'll see you next time.